Today, we're going to do something a little bit different. I'm going to follow up on, follow up and complete part 4 of the Building a Forex Strategy mini-series that I've been doing over the winter. How many of you guys have been watching that? How many of you guys are all caught up on that? How many of you love it? Perfect. David says, caught up, it's great. Love it. Give me more, really good. Yeah, it's something I did last year on the platform here and want to do it again. And for you guys that aren't caught up, essentially each winter I take some time to work on my own trading, right? During the rest of the year, I'm all focused on you guys. During the winter, I take usually about 4 to 6 weeks to kind of do what I call continued education. So it can consist of obviously reviewing my trading for the year, making any adjustments that I need to make, reading any books, taking any courses, attending any webinars or seminars. And this year, as well as last year, was a combination of both reading some books and strategy development. And we started off really the first Q&A in December. I started breaking down. We actually did a first kind of what I thought would be a diary here in the Q&A session, right? Do you guys remember what we were looking at back then? Do you remember the initial thought of what I was trying to do, or the direction I thought I was going to do? Yeah, Gabrielle says the bands. Yeah, we're looking at Bollinger Bands and perhaps Keltner channels and looking to make a strategy based off of that. And really that was something that followed up on kind of unfinished work that I did the year before. Well, one of the things that this series has been putting an emphasis on is how things change. Things change as your mind is allowed to be creative. And the strategy that I'm working on now has really nothing to do with Bollinger Bands or Keltner channels, right? None of them are involved. However, what's interesting is that many of the concepts that I tested that I thought would complement a previous system, either this year or last year, just in my experience as a trader, have come back to really help. And I guess the point of the whole Building a Strategy mini-series is to tell you that, you never know what's going to happen, right? Strategy development and life in general is a series of try and fail. The difference between those who are successful and those who are struggling is that those who are struggling, they try and fail and just keep moving on to the next thing. Those who are successful, what do you think they do between try and fail? Try, fail, and blank before trying again. Yep, try, fail, and learn. So they don't look at failure as a say-all, be-all, or as like, oh, a pity party, oh, I stink. They look at it as a learning experience, and that learning experience can come back to help you in many different ways. And that's been really the big thing that's helped me here with this strategy. So in part 1, we talked about doing the baseline test, testing the initial hypothesis, just an idea. Think about it as a if-then, right? If this occurs, then I would expect the market to do that, and just generating some basic numbers, really no rules. And by the way, this is all preliminary, not even back testing. This is just strategy development. So this is the entire process, right? 4 weeks of whatever that goes in before I can actually back test, just developing rules and concepts. So part 1 was the baseline test. Part 2 talked about filtering entries, right? Looking to really get rid of some losses by adding confirmation to entries. If you guys remember, I tried a few ideas and most of them failed, and then kind of moved on to the next part, which was part 3, which was working on stops. And what was interesting was that, was it working on stops? Now I'm all confused. What was part 3? Part 1 was the baseline. Part 2 was entries. Part 3 was profit targets. There we go. Profit targets was part 3. So instead of just doing kind of holding a trade until I'm stopped out, it was actually having some set profit targets to shoot for. Excuse me, got something in my mouth. Part 4, which we're going to discuss today, this is working on exits. So if you notice the trend, what I'm looking to do is this. I'm looking to take the initial baseline strategy and I'm looking to cut down on a few areas, right? I'm looking to, right, because entry, stops, and targets, those are the three things we always need to worry about. So with entries, I'm looking to somehow get better entries, right? Filter out some of those losses, typically by waiting for confirmation, like an entry signal. So think about the difference between putting a limit order on something versus needing a lower low, lower close, right? Targets is having a defined target location, right? We talked about maximum favorable excursion, really understanding how far the market goes in your favor before it stops and starts to go the other direction. So trying to get an idea for that and seeing how much you can milk out of the trade before you get too greedy and you start giving some back. And then exits is, let me ask you guys, what do you think exits are? What do you think we're going to try and accomplish here with an exit strategy? Ooh, yeah, making you think today on a Monday, I know. Losing the minimum while catching the most profits. Maximum adverse excursion, which is the exact opposite of maximum favorable excursion. So basically, how far the market goes against you. Latch is typing in right now. What do you think, Latch? Manual exit? Manual exit? We got one more person typing in too. I'd like to make you guys think here. Trailing your stops. Essentially with exits, here's what you're looking to do. Looking for something that will take me out of the trade at the first sign of danger, but not so soon that it sacrifices profits. Does that make sense? I'll bring a chart up for you guys real quick. Right? If we look at a chart here, say that again. Yeah. So what we're looking for with exits is this. We're looking for something that will take me out of the trade at the first sign of danger, but not so soon that it sacrifices profit, right? So you look at the chart in front of you, right? Imagine that the market's moving like this. This is that maximum favorable excursion, right? This is as far as the market goes in your favor. And then what happens after something has reached its peak? Something has gone as high as it can go. It's reached its apex. What happens after that? It pulls back, right? So ideally, you want a stop loss, an exit signal that's going to take you out as close to this highest point as possible, correct? Would you guys agree? Ideally, right, you want to be able to exit at the very top, right? Calling tops and bottoms, right? That's everyone's goal, to exit right at the high of this wick over here. Get every single penny out of the move. Right? However, what is the downside of trailing too tight? I know many of you guys are doing that. I spent a lot of time on the chat this winter. It's been amazing because all of you guys, we've been in this miserable cycle, like 10 of us that have been back testing, and we've just been hanging on the chart complaining about it for the entire winter, which has been awesome. But what happens if you trail stops, or if your exit signal is too close? Well, you don't give the market a chance to breathe, because we know that although I drew a straight line, you see a straight move right here on the pound dollar hourly. How do markets typically move? Do they go straight up and straight down? No, they extend, they retrace. They extend, they retrace. They extend, they retrace, right? Before the eventual kind of reversal. So if you're trailing too tight and you're stopped out on this retracement, what are you sacrificing by doing so? What are you giving up? Yeah, you're missing the rest of the move. And that's a very slippery slope, because guess what? Do we ever know when the move is going to end? Do we ever know whether it's going to be a simple retracement or a full reversal? We don't. So that's the balance that you have to find. We got to find that balance between, I want to trail tight enough or get an exit signal that warns me close enough to so that I don't give back too much profit if the market were to reverse. Yet, I don't want something so tight, or so I don't want something so loose that it gives back all of my profit. And I'll give you an example. The first thing I was doing, this is one of my go-tos, and I'm still using it in the strategy, is the Parabolic SAR, right? We talk about this as one of my favorite ways to trail stops. I'll make it a little bit easier for you guys to see. But the Parabolic SAR, let's make this I can't get a dash in here. How can I get a dash? You can tell I'm horrible at this. Let's just do this. Thicken this up, right? Right? So you see these crosses, right? I'll make this a different color for you. These crosses are trailing price. Can everyone see that? And you can see it's trailing it pretty loosely, right? Now let's say I take a trade right down here, right? I'm super awesome trader. I trade it right at this breakout down here. Market expands up, right? We're up how many pips right now? We get right involved here for some reason. We're currently up 90 something pips. Look how far that trailing stop is. That trailing stop is essentially at your break even. And what happens if you use this, and you can change the parameters of it and whatnot, but what happens if you, one of the, I guess I don't want to say it's the downside, everything's a give and a take, but what happens with this indicator is if we get a sharp directional move backwards, guess what you just given up? All of your profit. So this was something I used in the baseline test. I still think it does a very good job of trailing, but you got to look at this from a realistic perspective. And I noticed from trading some trend trading strategies in the past, how comfortable are you with being up, say, 200, 300, 400 pips and watching it all go away? Or even being up 600 pips, but then finally taking profits at plus 300. Is that something that you think you can consistently do without sabotage? Or is that something you think that's going to kind of mess with your psyche? And there's no wrong or right answer. I just love to hear what you guys think. And this is the part of kind of knowing yourself. And we'll talk about it later, how the most profitable strategy isn't necessarily the best one. But who thinks that would bother them? Being up 100 pips, 200 pips, and then giving it all back? Or being up 600 pips, still having a profitable trade that's, say, plus 300, but knowing that you're up 600 and you only collected 300? Now imagine doing that over and over and over and over and over again, right? It's probably okay you do it the first time. No big deal, still made some money. But over and over again, it starts to wear on you. And that's one of the things that wore on me so long ago when I traded a very similar trend continuation strategy. It hurt a lot to be up that much and give it back. So I want to have a tighter way to trail, and also a set profit target helps with that as well. So one of the things that I implemented was a different type of trail stop. It was actually something that I was experimenting with for entries that failed. It was my good friend the stochastics, which you guys know I don't really use them, but that's kind of my second go-to indicator after the RSI. And the stochastics did a great job of giving me exit signals that were very close to the highs. Meaning at the slightest retracement, we'd see an exit signal on the stochastics that would say, get out the trade, right? Now that's a positive, correct? Let's see if I actually throw one on and see if it actually works in this scenario. I'm on a random chart right now, but we'll see. Yes, look at this. So if we just do a simple stochastics cross, right? We would have gotten our cross right about, nope, this candle, right? So we would exit right up here. Not bad. Pretty close to the highs. Would you guys agree? Nothing's going to be perfect. Pretty close to the highs. However, what did we talk about earlier? What's the downside of this? there are going to be many scenarios where guess what happens? Market gives us a little bit of retracement, right? This doesn't even look to be a 382. Oh, I got my white fibs on, but I can eyeball it. Yep, right about a 382 retracement. Could still be in a very strong trend with 382 retracement. What if this happens? Yeah, we could miss the extension further. And as I was going into my testing, and once again, this was something that I was very confident about. Again, I looked at the stochastics. I changed the settings a little bit, but I looked at them for an entry qualifier, and just eyeballing it because I was looking for entries, and it failed to be an entry qualifier. But it was like, ooh, I think this is going to work for exit. So I kind of stashed it away and said, ooh, part 4, let's revisit this. And I was a little bit excited just by the eyeball test. And the eyeball test is always difficult because guess what, guys? When you're testing, you see what you want to see. That's the reality, right? I don't think anyone goes into testing wanting something to not work. You want something to work. So typically you go into it and you kind of focus more on the good and kind of ignore the bad. That's one of the things that I do during back testing is I purposely try to look for losing trades because of that. We know that we want to see winners and we want to avoid losers. So I always want to look for losers kind of to keep it honest. But I tested it out for exits, and how do you think it worked? It was horrible. Horrible, guys. Horrible. It did a good job of exiting early, but there was so much meat left on the bone that it just wasn't worth it. So I went back to something else. During the winter, I reread a book, one of my favorite books. I know Latch had read this as well. RSI, the complete guide by John Hayden. I love the RSI. You guys know it's the indicator I use, and I love the different ways of using it that are not just the traditional ways of oversold and overbought, but using it to gauge strength. And I actually played around with the RSI, put it on there, and found a way to use the RSI, which gives me a good exit indicator. It's a little bit less. And RSI was the third thing I tried. I tried a few other things first, but it was a little bit less traily, less tight. I guess looser. It was looser than the stochastics, but it still gave me exit reasons that were before the Parabolic SAR. So it was kind of in the middle. Does that make sense? Was it Goldilocks and the Three Bears? Had one part was too cold, one part was too hot. One was kind of just right. So I implemented that and I combined it with the ATR test that we did before, right? If you guys remember, we did some testing on the ATR for targets. You can see it should be this middle one right up here that says naked. Let me know if you guys are seeing that on your screen. Yep. So I combined that same thing with the RSI zones, right? Because I wanted to have a set target. I'm not just a fan of, again, just letting something hang out until the market retraces and stops me out. It's just not something I'm comfortable with. So I want to have set targets, right? We found the sweet spot with the ATR, right? We found that we can go up to 2.5 ATR before it starts having a negative effect as far as target taking goes. So I combined that new exit strategy with the ATR targets, right? So again, we're slowly putting the whole thing together, right? Baseline test, we develop entries, we look at target taking, we look at stops, we put it all together and see how it works. And you can see down here in the bottom left, right? These are the results just testing that exit strategy with a 1 ATR target, a 1.5 ATR target, a 2 ATR target, and a 2.5 ATR target, right? And you can see out of the four, the 2.5 ATR target worked the best. Now, what I wanted to achieve here, right? Because many of you guys are looking at the total profit number, right? And that is important, don't get me wrong. But what I wanted to achieve here with the exit strategy is what? What do you think the main goal was to do? If you guys are new to the Q&A, like I'm not, I just don't like sitting and talking, right? Or standing and talking. I like creating a conversation. Scott says consistency. Expand on that, Scott. Consistency meaning what? And there's no wrong answer, guys. So spew out the mouth, right? This is the best way to learn. If you're wrong, I'll say, nope, that's not it. If you're right, it is right. Increase margin, no. Matt says average trade, close. That makes sense, average trade, yeah. Balance out to suit your personality and still milk the markets. With an exit strategy, the point of an exit strategy is to reduce your losses. And if you look at the average losses across the board, right? And again, this was no exit strategy, right? 169, 170s. This one doesn't count. This was a qualifier. If you guys remember, that took out basically every trade. It took it from 235 down to 31. So too much filtering. But 169, 200, 190, 180, 174s, 207, 185, right? Now look at these numbers. 150, 140, 130, 130, right? So reducing the losses on average by 40 to 50 pips. On average. On average. Now again, we want to think about everything realistically, right? That may not seem like you guys are looking at this and you're probably saying, okay, well, what's the difference between 190 and 140, right? Think about you being involved in a trade, guys. Think about cutting down 40 pips per loss. Is that something you would be interested in? Is that something that's going to allow you to be more comfortable? Something that's going to allow you to be more confident? And we know when we're comfortable and confident, usually we say comfortable in a negative sense, but in this case, comfortable is good. Comfortable, confident, that's going to lead to less psychological mistakes. The less psychological mistakes you make, the less likely you are, the less you self-sabotage. The less you self-sabotage, the more you collect. The more you collect, the better chance you have of being a consistently profitable trader. Now, on the flip side, you see that it does decrease the average win, right? Again, there are some really, really big home run trades. We'll talk about that in a little bit, but with any trailing stop, there's going to be instances where you get that exit signal, right? Takes you out, and then the market expands. You're going to miss a bigger winner. That is just life. There is give and take to everything. I said I would challenge you to find a system or a strategy that gets the maximum of every win, but also takes you out. But that's going to be an impossible journey. So don't even do it. So you're going to sacrifice something. The key is understanding, what do you value more? Yep, finding the sweet spot, as Cody said, but also, what do you value more? Do you value minimizing losses, or do you value maximizing wins? And for you guys that know me, right, my number one rule of trading is conservation of capital, risk management. I would much rather minimize my losses than maximize my wins. So that's just the give and the take. So you got to make a decision between one or two. Now, you'll see that I have a few things highlighted in yellow, right? And by the way, it's at this point I have kind of an idea of everything that I want to do, right? I have my entries. Actually, I wasn't able to find a filter for entries, so that's going to be just naked. It is what it is. But I was able to find a sweet spot for targets. I was able to find an exit indicator that I like. So I'm getting very, very close at this point to having the final rule set. Now, the question is, which one of these do I want to choose, right? And you can see that I have highlighted in yellow 1.75 ATR for this type of test, meaning this is the ideal strategy for me. However, you'll notice that what? Is this the most profitable one of the bunch? No. You'll notice that down here, if the RSI zones, I have 1.5 ATR. I should probably actually go test 1.75. I should do that. I got lazy. Is this the most profitable one of the bunch? No. Who can guess why I chose those? I don't think you're gonna get it. This was something I actually, it kind of didn't make sense to me until I actually put it on a graph, until I checked out the curves. Cody says average win percentage. Yeah, we didn't touch on that today. Win percentage is important as well. Again, my threshold is about 40, so anything under 40 is like danger zone for me. So that is important. I do like that. I think it's natural to like to have a higher win percentage. I mean, I would love a 62% win percentage. That'd make me more comfortable than a 42. That's correct. Drawdown, yeah. So I'm going to bring up a few curves for you, right? First is our initial curve from the baseline test. And again, let me make sure you guys are seeing this on your screen correctly. Might be a little bit blurry, but hopefully it gets a little better for you. Give me a yes when you see it. Yep. This was the baseline test. Again, no filters, no anything, just hypothesis testing. Who remembers what the big negative, it's right there in your face. Who remembers what the big negative was from this curve? The drawdown, right? Everything was great. Everything was great until we got here and gave it all back, right? Big red flag. Again, we talked about in part 1, right? Many newer traders looking at this right here and saying, ooh, yeah, look at that. Look at that boost. That's if you can survive this. And guess what? This is what happens to a lot of traders out there. They start off well, they blow their account right here, and they never survive to see the rest of it. So the big problem was that massive dip in the middle, right? So I wanted to clear that up. So we did so with kind of smoother target taking. But I want you to look at this as well. Look at, real quick, here was a chart where we kind of smoothed it out a little bit, right? So you guys would agree that this looks a lot better, right? This curve than the first one? Yeah, a lot better. So here's a chart of the optimal way to trade, the one that gave me the most net pips, right? This 2.5 ATR. And I want you to tell me what you think about this curve. What are your thoughts? Positive, negative, smooth like a baby's butt, rugged like my beard. Ollie says smooth criminal. Bobby says minimum drawdowns. David says took a while to go into profit. Went to profit right away, David. Look at this far left. I mean, the first trade was down. But then after that, wasn't right into profit right away. Yep. Although there was the big negative dip where everything was given back to the markets, there was a period in the middle where we went sideways. This actually looks exactly like my equity curve from the year, man, what was the year where I had like a 26-week drawdown? It wasn't really a drawdown, it was sideways. Was that, it wasn't 2012, I think it was? One of those years, man, summer was rough. But yeah, we went sideways for a long time, right? So this is not necessarily a negative, right? Because sideways is better than going down. But if you look at this sideways movement, right? This goes from what? About trade 61 to about 151. Do you guys know how long that is? Remember, this is a daily chart strategy. That is from June 2013 to March 2016. I repeat, that is from June 2013 to March 2016, right? So that is about 3 years. That is about 3 years. Now, going back to reality, right? Because there's a big problem. David says I would have given up by then. Yeah. I mean, your confidence is going to get beat to death by then. You might have thought the strategy doesn't work anymore. Yeah, you might have given up on it. I wasn't even thinking those when I was preparing today's lesson. I wasn't even thinking about those. Those are very good, valid points. What I was thinking is even this, right? For you guys that plan on going into either some sort of full-time or part-time trading. Any type of trading where you're actually where you're taking profits from your account and using them to help, fund your life. Or if you're managing money for others. You need an income, do you not? If you're not making profit over a 3-year period and you're relying on your trading to fund some or part of your life, you still need to take money out to pay for bills and whatnot. What happens when you take money out of your account but you're not actually making profits? This sideways curve actually starts to go down, right? You're actually losing money. Money management is very similar depending on how you set up your deal. I told you guys when I got into money management, I had a very sweet deal for my clients because I just needed to get a foot in the door. So I only charged commission, using that word loosely, of course, on new equity highs. Meaning that I didn't take a percentage, I didn't take a cut, I didn't get paid unless I brought their account to a new high watermark. So you can see we hit this high watermark here at about 6,000, and then we don't do that for 3 years. Guess who's not getting paid for 3 years? Not very realistic. So although this was the most profitable way to trade it, it's not a way that would work for me in real life. There are some negatives to it. Now, of course, right? Remember, this is a test on a single pair, right? So when you go through your actual back testing, you test a portfolio of pairs. This could be an outlier, right? There could be other pairs that really shine during that time. But that period of time, right, just knowing different market conditions, that was another time of low volatility. Very similar to what we're seeing now. No difference why you're seeing these are recently 2018, 2019, why we're seeing this go sideways as well. Low volatility times are going to cause for choppier markets. Choppier markets, not necessarily great for trend traders. This is why we test over different market conditions. The key is what we talked about before is to survive those times and ride it out to the next, period of directional movement and not get destroyed by it. So, going back from 2.5 ATR of targets back to 1.5 ATR made the curve a little bit smoother. But you can still see, right, a little bit of, it's still kind of sideways, right? The period isn't as long. It's not necessarily 3 years. This one, I think, is June 2013 to October 2014, so about a year. But still a little bit of a kind of a struggling period here. However, when we go to the one with the exit qualifier, with the 1.5 ATR, that's the one that I had highlighted in yellow, we get this. What do you guys think about this curve? And I wish I had time to overlay them on top of each other. I just didn't get to that. I finished this up late last night, so I was pretty brain dead. But wanted to give it to you here in the Q&A. But better, yeah, smoother. Now, not as profitable. Not as profitable. And the reality is, you're gonna have, if you trade this way, or if I trade this way, I'm gonna have to deal with taking profits off and seeing markets have mega moves, right? There were a few outliers here, and you'll see this with any trend trading strategy. There were a few outliers in the initial testing, which gave 1,000 pips. 600 pips. And just as we talk about, it's difficult to be up a certain amount and give it all back with a trail stop. It's pretty difficult to take profit out. Let me know if you've been here before. It's pretty difficult to take profit out and then see the market continue in your direction, right? It's pretty difficult to be like, yeah, 200 pips, woo! And then the market goes for another 500 and like, I was in that, I should have had it. But that's another sacrifice that you have to make. And for me, when I get those situations, I always come back to looking at curves and kind of realizing what my purpose is. And my purpose isn't to catch the big move, right? I can easily set up a strategy where I can catch the big move. It's going to have a very, very low win percentage. It's going to involve a lot of giving profit back, but it will catch those big moves. I am very comfortable with taking less profit, but having a slow, consistent return. That may not be for everyone. And when we end up, if this passes the back testing and it ends up working, and I put together a training course on it, we'll talk about different ways you can do it. You guys kind of saw the charts already. And for you guys that are into shooting for the moon, you can have that option, whether it's a single target or maybe a secondary target. But me, and this is kind of my counter trend mindset. I always told you that I'm a cookie jar trader, right? I want to reach into the cookie jar. I want to grab a crumb. I want to take my crumb and not get caught. And I want to do that over and over and over again. And I'm okay not taking the full cookie. As long as I can consistently get away with my robbery. And that's all I'm looking to do. I'm looking to get in, get out, or get in, get some profit, get out. And what I like about this curve the best is that you don't really have that drawdown period. I don't have to go obviously I don't have to give it all back like in the first example. I don't have to go 3 years of going sideways like in the second example. I don't have to go a year and a half, whatever it was in the third example. This one's it's a slower journey to the top, but it's pointing in the right direction. And I'm okay with that. Can you repeat what you did to smooth it out? Sorry. This was using the RSI exit strategy. And this was also taking it from, where's my chart if I can find my internet? This was also taking it from 2.5 ATR to 1, so reducing my target, right? Again, 2.5 ATR off the RSI zones exit strategy had the most profit. However, it produced a curve like this. Not a bad curve, but still that long period of drawdown. And remember this, whenever you take more profit, what's going to happen to your win percentage? It's going to drop typically. So although this produced more, right? There were longer periods between those wins. And here's the cool part. If we get a chance to look at this, I hope you can see it. And this is going to kind of answer Jess's question. I shared a chart in part 4. And a lot of you guys, or part 3, excuse me, a lot of you guys joined me like, ooh, cute. That table looks so clean, right? My testing isn't clean, guys. Look. Ami says how, real quick. How what? Before I get into that. How what? Because I know I'm going to lose my thought process. Whenever you take profits, your win percent. No, whenever you take profits, the bigger profits you take, typically the lower your win percentage will be. So if you're trying to shoot for more targets, the larger targets, price is going to hit those larger target levels less often. So think about it like this: like if your profit targets were 1 pip, you'd probably have a very high win percentage. If your profit targets are 5 pips, right, you're going to have a lower win percentage, right? Because every trade that hits 5 pips hit your 1 pip target. However, not every trade that hits your 1 pip target is going to hit your 5 pip target. And you can see here in the charts. I mean, look at win percentage from 1 ATR, 57, 47, 42, 41, 62, 53, 48, 46, 44, 42. Right? And again, I'm not saying win percentage is the big deal. You need to know your comfort level, right? We've been talking about that throughout the series. You need to know what your zone is, right? Some of you guys are like 42%. Some of you guys like 42%. Whew, amazing, right? So you got to know yourself. Just understand it is going to drop, and this is all about finding balance. What was I talking about before? Back to clean, not clean. So here is looking at the 2.5 versus the 1.5, right? And again, these are all different tabs I have for my different tests. So baseline, RSI, the rocker ATR, the MACD, the regular ATR, right? These are all different comparisons and tests that I make. There were a few others that got deleted because, again, they were just trash and didn't work. But we go to the RSI, right? And this is what it typically looks like, right? So it's not as clean as you guys think, right? It is lots of numbers and lots of columns, and I color code everything to keep track of what I'm doing. But you can see it's like the matrix, right? Just numbers floating around everywhere. So this may be clean to some, but it's all about being organized. If you look up here, each thing is organized in a different column, right? So this was what the RSI test. I have 1 ATR, I have 1.5, 2 ATR, blah, blah, blah. This is the running total on the side. And what I like about this is because it gives me a chance to experience, again, this is just baseline testing, guys, or initial strategy development testing. What I like about this is I can see how the running total performs for each, right? So you can see, look at this 2.5 ATR, right? Blah, 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 blah. Let's go to the end of year one, right? 2009, right? 1900 pips, right? 1950. 1.5. Was this 1.5? What was that? This is 2.5. Excuse me, 2.0. 1,000. 1.5. 17. 1 ATR. 2,000. So at year one, which was performing the best? The 1 ATR. Right? You can go down to year two, wherever that is at. Year two. This one starts to take over. Right? But then, look at that. At some point, it goes all the way back down. 36. This is down to 27. So you can see as you're going back and forth, this is going to go through different ebbs and flows. These are those different wiggles, right? And this is the difference, again, looking at our trade right here. This is the difference between having a slow and steady, smoother equity curve versus a choppier one, right? Does that make sense? Just put back into your head the two equity curves I showed you. Year one, this was up. Now it's down in comparison to the first one. We haven't even talked about this middle one right here. This is the one I ended up using, the 1.5. This one's been down the entire time. This one hasn't performed anything. But then you keep going down, you can see, okay, well, this one comes back. Nope, not yet. At some point it comes back. At some point. Here we go. This one comes back. Now we're looking at what? 52. This one somehow took the lead, 53. This one's forever down, 41. This one's back in the lead, 54. Right? So I like to test and compare all at the same time. Not just because of that, but it's easier to do. It's easier to track data when you're just tracking everything at once. But you can kind of see the journey in which it goes through. And mentally, while I'm doing this, I'm judging it, right? I'm looking at this stuff like, 2.5 ATR, you loser. I'm gonna track you anyway, but no way I'm using you. And then I go through it. I'm like, oh no, it's coming back. Oh, what? No, I knew you were a loser, right? And you're going through all these mental battles in your head. Steven says, did you automate any part of your testing? No, I did not. I do it all manually. It would make life a lot easier if you automated it. But again, what I love most, and this was the whole part of the series, what is the most important part of this whole journey? Because this thing still may not work. I have no idea. What's the most important part of the journey? It is the process. Do you guys know? You can see the numbers in front of you, and you can see all the tabs at the bottom. Do you guys know how many trades I've went through? Right? 235 trades, right? 11 years of data. For each test. Should I remind you how many tests there were? Do you know how much I'm learning from that? And remember, many of these ideas weren't even on my brain. Using the RSI for an exit indicator wasn't even in my initial thought process. I thought it was going to be an entry qualifier. But because I did so much testing and I saw it, I look at it and I track it. I go, that looks interesting. Let's jot that down. Didn't work there, right? Now I have ideas like, well, that kind of worked during that choppy period. I wonder if that would, and then you test it, right? So you don't develop those ideas, right? You don't have that creative process, like Jason said. You can't get that from automation. Automation is great in the fact that it's going to spit you out a number really, really quick. I was really jealous of Jim when we were doing the Bollinger Band stuff. I'm here, slaving in front of my charts, right? Trying to get I'm on year 5. I'm bloodshot. My eyes are bloodshot red. And Jim's like, yeah, I just did 4 years of testing for click of a button. I'm like, F you, Jim. He's like, I'm going to head out and enjoy some time with my wife in the cabin. And I'm here just dying. And I was like, you know what, buddy? F you, man. So there are massive benefits to that. But you don't get the same type of experience. And you can do both. I mean, you can do both. Don't get me wrong. Once you know what you want, you can then automate it, or you can automate an initial thought process and then see if it works for a baseline, and then go back and do it manually. You can blend both. I'm old school, stone and chisel, right? Stone and chisel. How long did it take? I started. The entire thing started early December, but then when did I switch what I was looking at? Probably after our last Q&A. I think our last Q&A was talking about still Keltner channels and Bollinger Bands. So maybe December 23rd, 24th. So about 2.5 weeks. Maybe. Bobby said, well, that's quick. Yeah, but also I got nothing better to do, Bobby. So I have the luxury of I don't have to work. So I can just sit in my dungeon and, aside from spending time with the kids and whatnot, I can sit in my dungeon and test all day. So yesterday I put in a session from 8 o'clock in the morning till about 6 o'clock at night with a little gym time in between. So I have the time to do it. So now I'm completely off of track what I was talking about. But yeah, it's not as pretty as you guys may think. So that's where I'm at right now. Gabriel says it is clean. I guess it is clean. I'm not an Excel genius at all. We're going to talk a little bit later about doing some simple stuff in Excel, because I know Jessica had a question. But I'm at the point right now where I'm pretty convinced on what I want to track going into the backtesting process. Again, it's a sacrifice of pips, but you can make up for that with a strong portfolio. So I'm excited to go through the process. I'm fearful in a positive way that it may not work. All right. So all of this, and it still may not work. I don't get too excited. I'm typically I'm trying to be optimistic, but I plan for the worst. But it's been an exciting process. So I've already won. That's the cool part. I've already won because I've discovered new ways to use things that I didn't think about before. And if it doesn't work this time, it may be something that comes into usage in the future. But hopefully that gives you guys a good idea of what I'm looking at. I wanted the main point of this part 4 session was not only to talk about kind of the exit qualifier, but I want to show you guys the differences in the curves, right? Because if you remember, part 1, the main goal was to eliminate that, where's it at? Eliminate that nastiness. The main goal was to get rid of that dip. And with enough tweaking, I successfully did that. So I appreciate all of you guys that took the time out of your day to watch all 4 parts of this mini series. It was a lot of fun, and it was pretty cool that I can end things and finish it up right around the start of my trading year. So as always, if you're new to the channel, subscribe. Make sure you hit that notification button. That way you don't miss the next video. And do me a favor, hit that like button. That's the biggest way you can support what I'm doing here. And also leave me a comment if you have any questions, or if you just want to say, hey, Akil, awesome video. There's been some very good comments from some traders who are really loving the content here because it's different than what most people are seeing on YouTube. Most people are kind of seeing the quick fix. What you're seeing here is kind of the reality of what traders are going through. And there's been a massive amount of helpful hints that have helped many of you guys out. So I'm proud of that. I'm all about purpose. That was my goal. Cheers to a very exciting 2020. And hopefully this will be your best trading year ever.